Between 2014 and 2018, the 25 wealthiest Americans paid an average true tax rate of just 3.4%. That is a verified fact from leaked IRS data published by ProPublica in 2021. But the tax rate is not the real secret. The real secret is the 5-part system they use to make sure their wealth never disappears, no matter what happens to the economy. In the next 9 minutes, we break down 5 verified, documented wealth protection strategies used by the ultra-rich right now. Every single claim is sourced from official government records, academic research, or public financial disclosures. Strategy 1. They separate income from wealth. Most people earn salary. Salary is taxed as ordinary income, up to 37% federally in the United States. The ultra-rich structure their finances, so they rarely receive salary at all. Instead, they hold assets that grow in value. When they need cash, they sell and pay capital gains tax, which maxes out at 20%. Warren Buffett confirmed this publicly in a 2011 New York Times op-ed, writing that he paid a lower effective tax rate than his secretary. This was not illegal. The IRS tax code, specifically Section 1221B1, treats capital gains differently from earned income, by design. The result? Someone earning $1 million in salary pays up to $370,000 in federal income tax. Someone whose assets grow by $1 million pays zero until they sell, and then pays a maximum of $200,000. Same million, nearly half the tax. Strategy 2. They borrow instead of selling. This strategy has a name in academic literature: buy, borrow, die. The term was coined by Edward McCaffery, a tax law professor at the University of Southern California, in a 2021 paper published in the Virginia Tax Review. Here is how it works. Instead of selling appreciated assets and paying capital gains tax, the ultra-rich borrow money against those assets. Banks accept shares, real estate, and private company stakes as collateral, lending at interest rates between 1 and 3%. The loan is not income. It is not taxed. The assets continue to grow. Bloomberg reported in November 2021 that Elon Musk borrowed over $57 billion against his Tesla shares, using this exact method between 2018 and 2021. The interest paid on these loans is often itself tax-deductible. When the borrower dies, their heirs inherit the assets at a stepped-up cost basis under IRS rules, eliminating the capital gains tax permanently. The loan gets repaid from the estate. The gain disappears. Strategy 3. Real estate depreciation as a tax shield. The IRS allows property owners to deduct the theoretical wear and tear of a building over 27.5 years, even when the property is increasing in value. This is documented in IRS Publication 946. A residential property worth $1 million generates approximately $36,000 in annual depreciation deductions. This is money the owner never actually spent. It offsets real taxable income. According to a 2023 analysis by the Tax Policy Center, real estate investors who qualify as real estate professionals under IRS rules, which requires 750 hours per year in property activities, can use these paper losses to offset ordinary income from any source. Many high-income investors legally show near zero taxable income while generating millions in actual cash flow. Strategy 4. Donor-advised funds. A donor-advised fund, or DAF, is a charitable giving account regulated under Section 170 of the IRS tax code. It is one of the least discussed wealth tools available, yet according to the National Philanthropic Trust 2023 Donor-Advised Fund Report, DAFs held $229.6 billion in assets and granted $52.2 billion to charities that year. Here is the mechanism. You donate appreciated stock, shares worth $1 million that you originally paid $100,000 for, directly into the DAF. You receive an immediate tax deduction for the full current value of $1 million. You pay zero capital gains on the $900,000 profit. The DAF invests the money tax-free, and you recommend grants to charities on your own timeline. Strategy 5. Life insurance as a tax-free investment. Certain permanent life insurance policies, specifically whole life and indexed universal life, allow policyholders to build a cash value that grows tax-deferred under IRS Code Section 7702. That cash value can be accessed tax-free through policy loans. This is not a fringe strategy. Major American banks including JP Morgan Chase and Bank of America hold billions of dollars in these policies on their own corporate balance sheets. It is called bank-owned life insurance, or BOLI, and it is disclosed in their annual filings with the Securities and Exchange Commission. The ultra-rich use these policies as a parallel investment account, one that grows without triggering annual taxes and can be accessed without creating taxable income. 5 strategies. Buy assets instead of earning salary. Borrow against them instead of selling. Use real estate depreciation to offset income. Donate appreciated assets through a DAF. Grow wealth inside a life insurance policy. All 5 are legal. All 5 are documented in the U.S. tax code. All 5 are used right now by the wealthiest people in the world. The system was not designed to be hidden. It was designed to be ignored. Subscribe to Hidden Wealth Files. Next video. 5 government programs that quietly redistribute billions every year. And almost nobody outside the top 1% knows they exist.